See this number? It looks like money, but it's not. The truth is your bank balance isn't real. The second you deposit cash or your paycheck hits your account, that money is no longer yours. The bank legally owns it. What you see is just a promise to pay you back if nothing goes wrong. And history shows things go wrong all the time. Banks collapse, investors pull out, loans go bad. The market crashes, and suddenly that promise the bank made to you is broken. Now this system goes back centuries. The first banks figured out not all people withdraw all their money at once, so instead of keeping 100% of deposits, they held back a fraction and lent out the rest. That's how fractional reserve banking was born. Take your money, flip it into loans, then pocket the spread. Now, to be fair, this system isn't sold as a scam, it's sold as progress. If everyone's cash just sat in a vault, it wouldn't grow. Banks put in the work by lending it out. They build houses, fund businesses, create jobs. In theory, fractional reserve banking makes the economy bigger and wealthier. You know, idle money is dead money, right? And sure, that's a pretty story, but most of that growth doesn't trickle down back to you. The wealthy get cheap credit, corporations expand, governments love the tax revenue. Meanwhile, regular people like you and me get overdraft fees and 20% credit card interest. So yeah, it creates wealth, but mostly for everyone except you and me. Fast forward to today, and the system isn't even really fractional anymore. In many places, banks no longer have strict reserve requirements. Instead, they operate under liquidity and capital rules, which basically lets them use nearly every dollar the second it hits your account. So when you see the balance on your app, it's not money in a vault with your name on it, it's the bank's IOU. And that's the scam. You think you're the customer, but you're not. You're an unsecured creditor. And that's fine as long as the bank keeps his promise, but what happens when they can't and shit hits the fan? Suddenly your bank balance doesn't look as safe anymore. Let me give you an example of how fragile this illusion really is. In March 2023, Silicon Valley Bank, a top 20 bank with over $200 billion in assets, collapsed in less than 48 hours. Now this bank was the go-to for tech startups and venture capital firms. During the tech boom, all the VC money poured in as deposits. Instead of keeping it safe and liquid, they shoved a huge chunk of it into long-term government bonds. Now on paper, bonds are safe. But when the Fed spiked up interest rates, those bonds tanked in value. Now the bank was suddenly sitting on billions in losses. What happened next was simple. They admitted it, started selling bonds at huge losses, and tried to raise new capital. Panic hit, customers heard, and in just one day, they pulled out $42 billion. That is a modern day bank run. By the next morning, regulators had to step in and shut the whole thing down. Now here's the twist. Depositors didn't lose their money. Normally, only deposits up to a certain limit are insured, but in this case, the government and regulators bent their own rules and guaranteed everything. Why? Because most of the clients were businesses holding millions in payroll cash. If they hadn't stepped in, thousands of businesses would have gone under in a week. So your bank balance is only as safe as the system behind it. One bad bet, one panic, and then billions vanish in 48 hours. This was a bank that lasted for 40 years, and it all still ended overnight. Now remember, those people got their money back and they were protected, but not because the system was built for them, and definitely not for you. It was all about saving the system itself, not the people and their money. At the end of the day, you can't stop the system from being what it is. Your balance is just a loan you've given to the bank, they turn it into a profit, then lend the money back to you at sky-high interest. Now you're in debt to the very bank that used your money. That's the game we're stuck playing. But you can protect yourself inside it. Use banks for short-term cash, bill payments, and emergency funds. Get the rest of your money out and working for you someplace else. That could be investments like stocks, index funds, or ETFs. It could be real assets like real estate or even precious metals. It could just be spreading it across different bank accounts so you're not dependent on one single bank. Now, none of these are risk-free. Markets crash, housing bubbles pop, and investments can lose value. But here's the difference. At least those risks have an upside. They give you a shot at building real wealth, maybe even generational wealth, and setting yourself up for a decent retirement. That's all I gotta say about that. See you in the next one.